Hi, Professor Barati. Let's go over some homework, week 6 assignment in my accounting lab. I'd like to go over some of the cash flow statements used under the IFRS indirect method. So this problem here, problem 6, is a apparel company has provided the following information for the current year. Information on the income statement, and information on the balance sheet. So we're going to take information from the income statement and information from the balance sheet and prepare a partial statement of cash flows. We're going to prepare the statement up until the operating activities or operating net cash from operations. So the requirement is compute cash flows from operating activities under the indirect method format. And this is an IFRS approach. So step 1 is your operating income. And you're going to get that right from your income statement. Right here, the $464,800. Then look at your income statement and see what are your non-cash outlays in the income statement that can be added back to operating income. As you can see, depreciation expense is a non-cash deduction. So our operating income is really higher on a cash basis. So add back your depreciation expense right from the income statement. We'll get to the tax expense later from the income statement, but now we're going to look at our balance sheet items based on the indirect method. The balance sheet tells us that our accounts receivables decreased by $29,600. So if you decrease accounts receivables, you're essentially adding working capital to your operating section of your cash flow. So a decrease in accounts receivable as a current asset is an increase in cash flow. Next is your inventory. Inventory also decreased. Therefore, a decrease in inventory, a current asset, is an increase in working capital. Think of it this way if you get a little confused. Take your current asset like inventory. It tells you it's decreasing. So say to yourself this simple step. On a debit or credit basis, what do I do to reduce inventory, a current asset? If I need to reduce inventory on a T account, that would be a credit. Therefore, I need to debit. Just think of the debit as increasing cash flow. So credit inventory to decrease it, debit working capital to increase it. Now, don't get confused. It's not an actual journal entry. It's just a hypothetical to help you not get confused of what goes up and down on the indirect method. So again, accounts receivable, in order to decrease accounts receivable on a T account, you credit it. So therefore, the debit is an increase to cash flow. Inventory decreases, working capital or cash flow increases by $43,200. Now, prepaid expenses increased. So to increase prepaid expenses on our T account, we would debit prepaid expenses to increase prepaid expenses. Therefore, pretend you have to credit working capital. And there it is, a negative to your working capital or your operating income. Increase in accounts payable, $34,600. So to decrease accounts payable, which is normally a credit balance, you need to debit accounts payable. So we're going to decrease in accounts payable is a debit, so we're going to credit working capital of $34,600. So a decrease in accounts payable means a decrease in working capital. To get this income tax paid, we're going to go back to the $145,800 tax expense that's on our income statement. Essentially, as you see, you take the $145,800, you subtract the income tax payable from your balance sheet right here to get a net $113,700. Which is reducing working capital for your operating section of your cash flow. Add them all up and you get a net cash provided by operating activities of $559,900. Problem 8 is a very comprehensive cash flow statement, which is a very good exercise to do. So we're going to walk through the steps. It uses the indirect method. Let's look at our income statement. We're mostly going to be concerned about the following items: net loss or net income. To do our operating section, we're going to start with net loss or net income. We're going to be concerned about bad debt expense because that's a non-cash expense. We wrote something off. We wrote off a bad receivable. So that was an expense, but we didn't actually write a check for that expense. Same things for depreciation. Same thing for amortization. Then we're going to go to our balance sheet. And the balance sheet is essentially going to be changes, differences from current year to prior year, differences in our non-current assets, increase in property, plant, and equipment, net. And then we're going to look at our changes and differences year over year from current liabilities, note payable, and shareholder equity. So in order to do a cash flow, basically you go through your balance sheet and look at your changes and take those ups or downs between your current assets, your long-term assets, your current liabilities, and non-current liabilities, which affect different sections of your cash flow statement. So let's start with the operating cash flow section. Net cash provided by operating activities. Step 1, you start with your net loss, which is given to us here. We're going to add back depreciation expense of $220,000. We're going to add back $35,000 in amortization. And we're going to add back bad debt expense of $66,400. Then we're going to go to our balance sheet. We incurred a deferred tax asset. If you remember, under the income taxes section chapter, we did our deferred tax asset and deferred tax liabilities. So, in current year, we increased our current assets by $260,000 from prior year. Therefore, we decrease our cash flow statement. So that's where the increase in deferred tax asset comes from. It comes from your balance sheet. Now let's go on to changes in our working capital accounts. Changes in operating working capital is our current assets versus our current liabilities. Changes. So we look at our current assets on our balance sheet, and we're going to look at our current liabilities, which represent our working capital. So current assets and current liabilities are your working capital. The changes from one period to another will go into the operating activity section of the cash flow. So let's look at our accounts receivable net. Accounts receivable current year was $200,560 versus the prior year of $189,830. Therefore, our accounts receivable increase went from $200,560, and the prior year was $189. So that is only a $10,730 difference. So accounts receivable went up $10,730 over prior year. So when receivables go up, cash flow goes down. So why do they have $77,130 here instead of $10,730? Because of the bad debt. Remember, bad debt, the entry to write off bad debt is credit receivables, debit the bad debt expense. Therefore, the accounts receivables was really $66,400 higher. So you need to add that back to the receivables. So the receivables really went up $77,130. Let's go to our inventory. Inventory went from $451,000, from $320,000 to $451,000. That means inventory increased over the prior year by $131,000. So if a current asset goes up, cash flow goes down. That's it for our current assets. Now let's go to our current liabilities. Current liabilities, accounts payable increased from $195 to $386,800. So therefore, accounts payable increased by $191,800. So if a current liability increases, cash flow increases. Remember my little trick. If you get confused between current assets and current liabilities and how to go, whether they go plus or minus, just ask yourself, accounts payable is a credit account. In order to increase accounts payable, I have to credit accounts payable. Therefore, I'm going to debit, which is increased cash flow. Let's look at our income tax payable. We went from $83,000 to $0, which is a credit balance. Therefore, we have to debit taxes payable to get it to $0. So we're going to credit cash flow by $83,000. The current portion of long-term debt is not in the working capital section. That's going to be done in the finance section because it's really long-term debt. Next, let's look at our purchased equipment. Our property, plant, and equipment net. Now, net means net of accumulated depreciation. So, our property, plant, and equipment went up by $2,190,000 from $1,560,000 by $630,000. But it really went up more than that because we had depreciation. Depreciation is in the net. So we have to really gross up our property, plant, and equipment. Now, a normal balance sheet would likely just have property, plant, and equipment at cost by itself. And then you would see accumulated depreciation as a separate line item. Therefore, you wouldn't have to go through this step. The accumulated depreciation, the difference from year over year, should exactly equal your depreciation expense. And you wouldn't have to add that back because your property, plant, and equipment wouldn't be net. It would be at gross. So we have to gross this $2,190,000 by the depreciation expense. So $2,190,000 plus the $220,000 in depreciation expense minus the $1,560,000 gives you $850,000 increase in property, plant, and equipment. Therefore, if we increase property, plant, and equipment by $850,000 on our balance sheet, we have to reduce cash flow. Now, your purchased franchise is going to be tricky. This is how you go about getting the purchased franchise. You literally have to go to a T account format. And you're going to be working with this section right here, intangible net. So your intangible net is essentially your franchise. So off the surface, it looks like the franchise increased by $9,060. So if we increased our non-current assets with a franchise by $9,060, our cash flow should be reduced by $9,060, but it doesn't work that way. You see a different number here, and this is what you need to do to get the purchase franchise. Set up a T account. For intangible net, your beginning balance is $131,860, which is taken right from prior year. So your prior year is your beginning balance. We know we had amortization of $35,000 right from the income statement, and that's taken right from your income statement or your cash flow statement. The amortization expense essentially is a credit to the intangible net asset as a accumulation of amortization. We know our ending balance is $140,920, which is right from our balance sheet. So the beginning balance of $131 minus $35,000 in amortization and an ending balance of $140,920 means that you need to plug what we added, what we debited to the T account intangible assets over prior year. It is this number, the plug, the $44,060, is what we increased intangible assets, and therefore you have to reduce working cash flow, which is right here. Therefore, your net cash provided used by investment activities is $894,060. Now, long-term debt. Long-term debt is going to be $220,000, and you're going to do that by doing the same thing. You're going to take your beginning balance right here, you're going to take the difference in your current portion, which is the $19,100, that increased. So because it's debt, the increase in debt is a credit to the T account. Therefore, your borrowing is the difference, because to get to your ending balance of $504,975, you need to take your borrowing, which is the plug, of $220,285. That $220,285, we increase long-term debt, we borrowed money, therefore we increase cash flow. So I'll let you look at this for a moment. So you start with your beginning balance right off your balance sheet. You reduce it by your current portion of your long-term debt, because you moved that to the current portion, which is right here. The difference is $19,100. And to get to your ending balance of $504,975, you need to balance it with $220,285. So you have to work T accounts to do this problem. Next, we go to our financing activities. We issued long-term debt of $220,285, which we went over. Now we purchase treasury stock, and that comes from right here on the balance sheet. Treasury stock. Okay, so treasury stock went up. Therefore, we purchased $438,000, $415,000 in treasury stock. Therefore, our cash flow goes down by that amount. Issued common stock. As you know, common stock has a par value, but then anything above that par value ends up in the additional paid-in capital. So you have to add these two numbers up, which are the differences year over year. These two numbers equal the $1,588,190. So by issuing common stock, we issued equity and we got cash. Therefore, our cash flow went up. So net cash provided by financing activity is a total of $1,370,000. Essentially, you're going to take your net cash provided by operating activities plus net cash provided by investment activities plus net cash provided by financing activities. All three add up to net increase in cash of $22,990. Cash and cash equivalents at the beginning of the year comes right from your balance sheet. Therefore, when they're added, they should equal your cash for the current year. Disclosures for the indirect method. Significant non-cash investing and financing activities, none. Accounting policy for the definition of equivalence for purposes of the statement of cash flow. The company considers all highly liquid debt instruments purchased with maturities of 3 months or less to be cash equivalents. Cash paid for taxes and interest. Cash paid for taxes. Cash paid for interest is right here, $75,170, which comes off your income statement. Cash is paid for taxes comes right in your taxes payable account. So your beginning balance of taxes payable is reflected on your balance sheet as a beginning balance of $83,000. But you ended the year with zero. That means you have a credit balance at the beginning of the year. You didn't do a provision. There was no current year provision adding to it. Therefore, to get to zero, you had to debit taxes payable. So your cash paid for taxes was at $83,000 on your disclosure. So that should conclude problem number 8, which is a pretty comprehensive problem. If you review this video a couple times to see where the numbers come from on your statements, it should help you get through it much quicker. Thanks.